Something on your paycheck quietly changed this year, and most people will not notice until they sit down to file. The tax rules for 2026 are genuinely different. A bigger standard deduction, brand new deductions for tips and for overtime. A larger break if you are 65 or older. None of this is a loophole. It is the actual law already in effect. So let's walk through what changed, in plain English, and more importantly, what to do about it. Here's the theme for the whole video, so keep it in mind. Almost none of these savings land in your lap automatically. Most of them only reach you if you set up your paycheck and your records correctly. Now, rather than discovering them next April, when it is too late to adjust. If calm, plain English money breakdowns are your thing, take a second and subscribe. No hype here. Just what actually changed and what to do about it. Let's be honest about why tax changes get ignored. They sound boring. They arrive wrapped in 10-letter words, and the people explaining them usually want to sell you something at the end. So most of us just tune out. And that is exactly how people quietly overpay. A deduction you have never heard of is simply money you hand back to the government for no reason at all. Nobody gives you a prize for missing it. There is also a lot of noise out there. You have probably seen the phrase no tax on tips or no tax on overtime thrown around online like everything is suddenly free. It is not that simple, and the details are where the money actually lives. So let's slow down and get them right. Start with the foundation, the one that touches almost everybody. The standard deduction went up again. For 2026, a single filer gets $16,100. A married couple filing jointly gets $32,200. Head of household lands at $24,150. That is the slice of your income the government simply does not tax, and about 9 in 10 people take it instead of itemizing. So picture a $50,000 salary. That $16,000 comes off the top before a single dollar is taxed, and this year that shield is a little bigger than last. And the rates behind it matter just as much. The familiar brackets, the 10, 12, 22, and 24% rates that most normal incomes live inside, were made permanent. For years, people worried those rates would snap back higher at the end of 2025. That cliff is gone. For planning, that quiet stability is arguably the biggest change of all, even though it is the one nobody put on a poster. Now the headline everyone has actually heard. Tips. If you work in a job where tipping is normal, waiting tables, cutting hair, driving people around, you can now deduct up to $25,000 of qualified tips from your taxable income. But read the fine print with me, because this is where the hype gets it wrong. It is a deduction, not a magic tax-free wand. You still owe payroll taxes on that money. It starts to shrink once your income passes $150,000, or $300,000 for a couple. And it is temporary, scheduled to run only through 2028. Real money, but with real edges. The overtime break works the very same way. If you earn qualified overtime, you can deduct up to $12,500 of it, or $25,000 for a couple filing together. Here's the catch most people miss. It only covers the extra half of your time and a half. The bonus portion, not your entire overtime paycheck. Same income phase-outs. Same 2028 expiration date. Still worth having. Just worth understanding. If this is already showing you money you did not know about, subscribe so the next breakdown finds you. Next, a big one if you or your parents are getting a little older. Starting this year, anyone 65 or older gets a new deduction of $6,000 per person, stacked right on top of the standard deduction they already receive. For a retired couple who both qualify, that is $12,000 of extra income shielded from tax. It phases out for higher earners, above $75,000 for a single person or $150,000 for a couple. And like the others, it is set to expire after 2028. If you help your parents with their money, this one is worth a phone call this weekend. Then there is the change that matters most if you own a home in a high-tax state. For years, you could only deduct $10,000 of your state and local taxes on your federal return. That cap just jumped to $40,000, and it holds through 2029. If you itemize and you live somewhere with heavy property or income taxes, that is a very large door that just swung open. It will not touch you if you take the standard deduction, but for the people it does reach, it is one of the most valuable changes on this list. Two quick ones before we land the plane. The child tax credit rose to $2,200 per child, and it is now tied to inflation, so it should keep drifting up over time instead of getting frozen in place. And there is a brand new deduction for car loan interest, up to $10,000 a year, but only on a vehicle assembled in the United States. And it fades out at higher incomes. Niche, yes. But if that is your situation, it is real money. And one more lever, the one that is fully inside your control. The amount you are allowed to save in tax-advantaged accounts went up, too. In 2026, you can put up to $24,500 into a workplace plan like a 401k and up to $7,500 into an individual retirement account. Every dollar you move into the right account is often income you are not taxed on this year. That is a change you can act on the same afternoon you hear about it. So what do you actually do with all of this? 4 steps. Step 1. Look at your paycheck now, not in April. Several of these breaks are meant to show up in your withholding across the year, not as a surprise at filing. Check the form your employer has on file, your W-4, and adjust it so you are not handing the government an interest-free loan for 12 months. Step 2. If you earn tips or overtime, become a record keeper. Keep your own simple log and make sure your employer is reporting those amounts correctly, because the deduction follows the paperwork. Sloppy records are exactly how real money slips through the cracks. Step 3. If there is any room at all in your budget, push more into that 401k or retirement account, toward the new higher limits. This is the rare tax move that also quietly builds your future at the very same time. Step 4. Before you count on any single one of these, check the fine print for your own income. Almost all of them shrink or vanish at higher earnings, and several of the shiny new ones expire after 2028. Treat them as a window that is open right now, not a promise that lasts forever. So let's bring it home. The standard deduction went up, and the familiar tax rates are now permanent. There are real new deductions for tips and for overtime, with real limits and an expiration date. Seniors get an extra $6,000 each. The state and local tax cap jumped to $40,000. The child credit grew. Car loan interest may now be deductible, and you are allowed to shelter more in retirement. None of it is automatic. All of it quietly rewards the person who checks their paycheck and keeps clean records. If that turns something confusing into something you can actually use, that is the best way to say thanks. So consider subscribing, and it keeps these coming every week. Next time, we are answering a question a lot of you have right now: where your cash actually belongs while rates are still high. T-bills versus high-yield savings versus certificates of deposit, in plain English. And the usual important reminder before you go. This is general education, not tax or financial advice. Every number here is based on the rules as they stand in 2026, and tax law can and does change. Your situation is your own. The phase-outs and the fine print matter, so check the current figures and talk to a qualified tax professional before you make a move.